Today's video is sponsored by SHARESIGHT. Use the link in the description below to try it for free or get 33% off an annual subscription. Chinese stocks are tanking this week, with tech companies like Alibaba and JD.com falling as much as 13% in a single day on Monday. The sharp drop comes after the President of China, Xi Jinping, made a number of moves over the weekend to strengthen and consolidate his power as the leader of the Chinese Communist Party. Changes in leadership, along with some comments over the weekend which may suggest China is moving back towards Marxism and away from some of the capitalist deregulation that's happened over the past few years, have some analysts calling China once again uninvestable. Today, I'm going to be breaking down everything that happened over the weekend and why it's having a dramatic impact on Chinese stocks starting this week. And I also want to talk about Charlie Munger's massive investment in Alibaba, including some clips where he explains how he thinks about some of the political and economic risks of investing in China. Over the weekend from the 16th of October to the 22nd, China held the 20th Communist Party Congress, and there were a number of changes and announcements that happened over the weekend that have added uncertainty to investment in China. President Xi Jinping continued to pave the way for him to serve a third term as president beginning in early 2023. And this actually breaks a long-standing precedent in China, which has historically limited the president and the vice president to 2 consecutive 5-year terms through a provision in the constitution. And there were some updates today, but the expectation that Xi would serve a third term consecutively has been known for some time, as all the way back in 2018 at the end of his first term, he was actually able to push for a change to remove that provision. So since 2018, it's been very likely that he has looked to want to serve more than 2 consecutive terms in a row. And if he does go on to serve the third consecutive term, that means that he will be serving till at least the beginning of 2028, if not longer. Over the weekend, Xi also announced the 6 new members of his core cabinet, known as the Politburo Committee. And all 6 appointments are considered to be close associates of Xi, which represents a change from the typical board of directors style of cabinet to a group of people who are clearly purely aligned with Xi's motivations. Of the 6 changes, Li Qiao was named premier. Qiao is a Xi loyalist who oversaw the strict COVID controls in Shanghai during the zero COVID policies. And while some of the restrictions have now been eased, back in April this included daily citywide testing, extremely limited movement, and transfer of residents to quarantine centers. And the appointment of Qiao as premier actually goes against a long-standing tradition of the premier first serving as vice premier. There was also 2 moments throughout the weekend that stood out and got a lot of news coverage today and yesterday. On Saturday, right after journalists were let into the Great Hall, Hu Jintao, Xi's predecessor, was filmed being forcibly removed from the hall. Later, a state representative reported that he was just feeling unwell and had to leave, although given the timing, some believe it was a coordinated display of power for Xi, especially given it occurred right before the 2,300 delegates unanimously voted to endorse Xi's new core leadership positions. The other notable event over the weekend was simply the overall tone and message of Xi's power going forward. Xi spoke about continuing to pursue common prosperity, as well as looking to further regulate income distribution and the mechanisms of wealth accumulation. Common prosperity is a political slogan used by the CCP, which reflects their goals of social equality. And common prosperity has been a slogan in China for decades, but over time, what it actually means in practice in terms of policy has shifted quite dramatically. Under Mao, common prosperity meant collective ownership over individual freedoms and other Marxist political policies. But after Mao, the term was redefined by leaders in China to allow for some people to get rich before others. But again, beginning in 2021, the term has once again become prominent, with President Xi describing it as meaning more equal income distribution, but not egalitarianism, which would seem to suggest he's not willing to go as far as Mao did with some of his Marxist policies, but does raise concerns about the capitalist improvements that China has been making for many years. And it's likely those discussions, along with the further consolidation of power, that spooked investors once the markets opened on Monday. One of the most attractive elements of investing in China in great companies like Tencent or Alibaba is that relative to their current earnings and even their future earnings power, those businesses are far cheaper than their similar quality businesses in the US. However, in order to actually compare US companies and Chinese companies on a cash flow basis, there's first kind of an underlying assumption that both businesses have a relatively similar ability to do what they want with the capital in their businesses. Think of it this way. If a business in the US produces huge profits, then most of the time its share price price will reflect the value of those cash flows, since the business is fairly free to distribute those cash flows how they see fit, whether that's out to shareholders directly, share repurchases, or to reinvest back in the business. But if China is looking to further their agenda of common prosperity, then large portions of those profits produced by companies in China might end up in the hands of the CCP rather than investors if greater restrictions on the distribution of income are introduced. And even though no policies or actions were actually announced or introduced over the weekend, the markets were an absolute bloodbath on Monday. The Invesco Golden Dragon China ETF, which tracks the USX China Index and holds about 65 companies that mostly operate in China but also do trade on the US stock market, it dropped almost 15% on Monday and is now down 78% from its February 2021 peak. Within the index, some of the top holdings include JD.com, which was down 13% on Monday, Alibaba, which was down almost 13%, NIO, which was down 16%, Baidu, which was down 12%, and then the Shanghai index, the broader Chinese market, was down a whole 2%. And almost 80% of you guys are not subscribed. So if you're not subscribed and you're enjoying the content, then feel free to hit that red subscribe button below. It helps me out a ton. We're getting super close to 100,000 subscribers. And regardless of what subscriber count a channel is on, by clicking that button, you're telling YouTube that you enjoy the content, and it encourages the algorithm to send it out to more people. So if you haven't subscribed and you're looking for a way to even support the channel in a free way, you can do that by hitting that red subscribe button. I'd really appreciate it. Let's get back to the video. So what has Charlie Munger had to say about the political and economic risks in China? After all, he has a massive position in Alibaba. In fact, he invested almost 30% of the Daily Journal's US stock portfolio in Alibaba during early 2021. He made an initial purchase of 165,000 shares in Q1 2021 when the share price was around $220 to $270 per share, and then he followed that up with a purchase of 137,000 shares in Q3 when the share price was around $150 to $200 per share. You'll also notice that at the end of the year, he purchased another 300,000 shares in Q4, and then he sold all of the shares that he bought in the first place in Q1 2022. We now know that those last two trades, the purchase of 300,000 and then selling all of the initial shares, were a tax harvesting effort where he was able to essentially lock in some capital losses at the end of the US financial year and either offset them from capital gains in that year, or maybe he'll drag those losses forward into future years when he does sell investments. But all in all, even without knowing specific prices that he invested into Alibaba at, we know that he's down well over 50%. In fact, it's very likely that he's down about 65 to 75% on his overall investment, which now represents about 15% of the Daily Journal's portfolio. And since he hasn't made any changes since the tax harvesting about 10 months ago, it seems like Munger has finished adding to the position. A lot of the political and economic risks and uncertainties that are happening today are potentially, you could argue, at an elevated level today than they were when Charlie Munger invested in the company. But they've also been embedded risks that have existed the entire time. So I wanted to go back and find some clips where Munger had spoken about his investment and investing in China generally to see what his thoughts are on how he thinks about some of these risks when placing money in China.
When you buy Alibaba, you do get a sort of a derivative, but assuming there's a reasonable honor among civilized nations, that risk doesn't seem all that big to me.
It's becoming quite evident that Chinese companies could be banned from doing business in the Western world, or maybe some of the Eastern countries too, because of the number of the following reasons. 1, the security threat issues. 2, the potential conflict over Taiwan. 3, inability to meet Western accounting standards. And number 4, human rights issues.
Well, we did it for a very simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China.
In that clip, Munger was pretty much point blank asked about political risks in China, and he simply answered by saying that the business is better and the stock is cheaper than other businesses in the US. And that seems to indicate either one of two things. One would be that he doesn't think the CCP will really interfere at all in the profitability of Alibaba and their ability to distribute profit to shareholders. or he thinks that the difference in how cheap Alibaba is relative to similar quality companies in the US, he thinks that there's a big enough margin of safety that even if the CCP interfered or interfered in some way, that it would still be a really, really good deal given that it's extremely cheap. But either way, he doesn't seem to think that it's a large concern for the investment.
Well, the Chinese government is worrying all the capitalists in the world way more than it used to. And of course we don't like that. And we wish that China and the United States got along better. Of course we should make friends with China. And of course we should learn to get along with people who have a different system of government. We like our government because we're used to it and it has advantages of personal freedom. China could never have handled its life with a government like ours. They wouldn't be in the position they're in.
I somewhat agree with what he's saying here. I think that it's easy for people who've grown up in a certain system to criticize other systems. I certainly think there is an element of that and misunderstanding culturally of what's normal given different political and different environments. But from an investor perspective, I think it certainly matters how the government deals with businesses because, as we spoke about earlier, you could have a business that's equally profitable in the US and one equally profitable in a different country, China or otherwise, and different governments may regulate how much of that profit can actually be distributed to shareholders or whether there's limits on that. And this is something that Munger actually never really commented on, even though he has been directly asked this multiple times in interviews, and I found that kind of frustrating. He always kind of just resorted to, well, it's a great quality business and it's a lot cheaper than US businesses, instead of actually answering the question as to how do you put a percentage on the probability of the business becoming worth zero, for example. With that said, Charlie Munger is one of, if not the investor that I align with the most, and that's because he's historically been extremely disciplined, extremely concentrated in his investments, and he's the one who was able to persuade Buffett to shift away from deep value cigar butt style investments to focusing on high quality businesses that you can be confident holding for many, many years. So regardless of my personal opinion and my lack of willingness to invest significantly into really cheap but high quality Chinese businesses, I am very curious to see how all of this plays out and to learn from it, even though I'm not investing in the space specifically. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Unlike data provided by most brokers, SHARESIGHT considers the impact of capital gains, dividends, brokerage fees, and currency fluctuations when calculating returns, which gives you a complete picture of your portfolio's performance. SHARESIGHT tracks shares and ETFs across 40 different stock exchanges, 100 currencies, commodities, and even cryptocurrencies and unlisted investments such as private equity. Plus, SHARESIGHT makes tax time a breeze by giving you a simple but comprehensive view of your capital gains and dividend income impact. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription.